Here at the Black Diamond Conference in Delray Beach, Florida, with Rick Rule. Rick, thanks for joining me today. How are you?
Oh, it's a pleasure, Albert. Thank you.
Enjoyed the talk you gave just now. It was centered around resource investing for the generalist investor. And the first question is, why would a generalist investor want to get involved in resource investing?
I think resources are a key component in a portfolio. After all, everything tangible in the world is either grown or mined. And missing out in your portfolio, the sector that's the basis of all of the stuff of life is important. Probably more importantly right now, the stuff of life in a historic context is cheap. People are focused on other sectors that have performed better of late. The best way to participate in the resource business is when there's no competition, when other people aren't there. And this is one of those times.
You talked about speculating versus investing. I personally think that there is a place in an investment portfolio for gold and some of the safer resource stocks. Do you agree with that?
I do. I believe that every portfolio ought to have some gold in it for insurance purposes. It's a very non-correlated asset. It's an investment that does well when other things do poorly. While I'm a long-term optimist, my near-term sense is that a 9-year recovery, economic recovery, which is what we're in, is probably a long-of-tooth recovery. If an economic downturn were to occur simultaneously with the beginnings of nervousness about debt, the circumstance in the broader economy could become very unpleasant. The truth is that if that happens, it won't be pleasant for you. But if you do happen to own some gold, my suspicion is it'll be much less unpleasant.
Right, and in the past, I've always thought that one should go for bullion if you're a conservative investor, and I still believe that to an extent. But one thing that the last decade or so has taught us is that even when you're looking for a when answer, the when answer could take a long time to come, and there's a penalty for holding gold bullion, whereas if you hold a conservative royalty streaming company, you can get paid to wait. And the other thing I like about it is the fact that there is, in some cases, leverage to the gold price means you don't have to dedicate as much of your portfolio to get the insurance policy that you're looking for. What are your thoughts?
I think you nailed it. I mean, I do believe that there's room, in fact, a compelling argument for physical gold in portfolios. But I also believe that the circumstance that confronts us today, one where the premium of gold equities over gold is at historic lows, argues for including high-quality gold stocks, as you say, particularly the royalty and streaming stocks in the portfolio. Traditionally, they outperform gold on the upside because their margins increase faster. But the other thing is that the royalty and streaming companies, as you say, pay a dividend. So to the extent that you're early, you get paid rent on your money. One of Buffett's chief criticisms of gold as an investment is the time value of money, and you obviate the time value of money by pocketing earned dividends while you wait.
Something in the news today. We had a lot of asset classes rising in the first quarter, and notably oil was one of the commodities that did okay. And it's a familiar commentary that I heard was, whoa, some of these oil stocks have lagged. And we've seen this before in other resources where the underlying commodity rises, but the equity doesn't. This makes sense because obviously these companies are not mere derivatives of their commodity. They have balance sheets, they have people, they have debts, they have... talk about some of the factors, for instance in oil, that may cause equities to lag commodities, and how long do you think that'll last?
The most important reason why the equities lag is because people don't invest on arithmetic, they invest on the narrative. And so until the narrative is proven, people don't act on it. So the oil price goes up, which nobody anticipated. For the first quarter or 2 quarters, they don't buy the oil stocks. It's only when the impact of the increase in the oil price, when the price action justifies the narrative, that people follow through. The other thing, of course, is that not oil companies, or not all companies in general, are created equally. As you point out, there are circumstances that are unique to every company. And I think that's important for resource investors to understand. One doesn't buy just any gold stock to participate in a gold rally. If one takes the added risk in equity, one needs to differentiate between the worst companies and the best companies, which again argues for a statement that you made earlier. Right now, the best of the best are the royalty and streaming companies.
So as usual, Rick, the planners here are making you work hard for the money they are not paying you. What else are you going to be talking about during this conference?
Well, today was really fun for me. I really enjoyed making the resource case to generalist investors, and I really enjoyed making the investment case to traders. That was really fun for me. The educational part of my background had a really good time today. What I'm going to do on Saturday is talk about what I'm doing with my own money, which is different than what I talk to people about today. I'm not a generalist, I'm a specialist. And although I am an investor, all the money that I make now, that I invest now, I made by speculating. And so on Saturday, I'm going to talk about what I do with my own money. So I'll be talking about three broad themes. The first is the mergers and acquisitions cycle that we're seeing in the mining business. A lot of money is going to be made buying the takeover targets. A lot of money is also going to be made backing the small companies that buy assets that are shed by the major miners in these mergers. Mergers and acquisitions going to make people a lot of money in the last 18 months. This will be my third M&A cycle, and the two prior ones have been an awful lot of fun for me. The second thing is precisely the royalty and streaming companies. These are better businesses. The markets think they're overpriced. The markets are wrong. The markets think that the growth period in royalty and streaming is over, for reasons I'll talk about Saturday. They're wrong. And then I'm going to talk about generative exploration. As a society, we've underinvested in exploration for 30 years. The chickens are coming home to roost. Every day that you mine, your business gets smaller. If you don't fill up that pipeline with exploration and development, you go out of business. Nice discoveries that are made in the next 5 years are going to make investors really, truly spectacular amounts of money. You're going to have to take risk to make that money. But the truth is that sector, exploration, is what has worked best for me in my 40 years in the minerals business.
Rick, thanks a lot for stopping by. Always appreciate it.
Thank you for causing it to occur, sir.